Hello, guys. I trust you are good. I trust you had a wonderful weekend. All right, you are welcome to today's episode of our analysis/education update. Today will be quite different from our usual analysis. I deem it fit to do a section on how to conduct an in-depth technical analysis. And as it is our custom on this channel, we often check, do an inventory of what how the trade that we took in the previous week actually panned out, our analysis actually how it's panned out. That is actually the first thing we do before doing the analysis. However, I want to you know change that tonight by starting with how to conduct an in-depth technical analysis. I hope this is really going to be of immense benefit to you. All right, because if we really want to take this as a career, as a profession, as a business, then I think this is critically important. It's critically important that we are able to do an in-depth technical analysis. Okay, so how do we conduct an in-depth, a comprehensive, detailed technical analysis? That is actually the title of this presentation or education or whatever it is to you. All right, so the first thing you should be able to do as a trader is to check economic calendar. You check economic calendar before you actually trade. Why do you need to do this? You need to consult your economic calendar to be aware of upcoming economic events, reports, and announcements that could actually impact the currency pairs you are interested in trading. If you don't do this, you'll be considered to be trading blindly because you are not keeping abreast of the economic events that may impact the currency you are trading. Your traditional technical analysis may be right, but there are some economic events that are of high impact, and because of that, it may disrupt your technical analysis. And this is why it is critically important you are able to keep abreast of economic events that may impact the currency that you are interested in taking. And how do you assess this event? Most traders go to forexfactory.com. There are a lot of websites where you can actually get this information. So I would encourage you can check Forex Factory. But for this presentation, I am going to use dailyfx.com as an example because I find it difficult to open my Forex Factory. Forex Factory presents it in a very simple format, and you can easily identify what currency and what event is likely to impact that currency that you are interested in. So because that website is not opening, is not available to me, I'm using an alternative source, and that is dailyfx.com. So when you come to dailyfx.com, you go to the economic calendar, and then you go to next 14 days. So you get to see the events, and this is not only talking about FX, is also talking about stock and other asset class. There are a lot of asset classes that could be impacted by economic events. So, but we are narrowing, today's analysis and today's lecture to forex currency pairs. So, you need to pay attention to events like, what are the events you need to pay attention to? Events like interest rate decisions. This is very important. These are high impact events. They have high impact on whatever currency that it's going to address. Right? Also, employment reports, GDP releases, they can cause significant market movements. These three events that I've mentioned: interest rates, employment report, and GDP. GDP is gross domestic product. So releases like that, even consumer confidence also. There are a lot of them. And then, so when you come here, you can check the date. Tomorrow is 30th. So you can check, and the currencies, Highland. You can, this would be GBP, right? All right, so you can just look at it: Australia, Aussie, Japan, Yen. And then these events are low. You can see the impact. This is a little bit high, is on the medium side. Just go through. You can read about those events. So you may stay away from high impact, currencies. I mean, currencies that has high impact events on them. Maybe on the day that you want to trade, you may stay away from them, because over time these events drive market movements, and sometimes this event cause whipsaw, like the market takes liquidity in both direction, up and down. In such cases, you are not likely to be profitable, even though these events are the ones that drive the market. Without these events, the markets may be very slow, may be considered to be slow, or to be in a state of consolidation. So, but this event brings about volatility, into the market. But there are some crazy events, like I mentioned. These three are very crazy. They move the market in a very, very fluid way, crazy manner. So you need to pay attention to economic events. I wouldn't want to overflog this point, but just go through, those data. This is 31st. You can see this is North Korea event. There is no USD right now. Just go through euro. These are high impact. You can see inflation rate. This is the forecast. So the forecast is lower than the previous, and which could actually, how do you interpret this? If the forecast is lower than the previous, that means there is a decline. So you should be expecting a decline in euro on this particular pair. But in a situation whereby this is GDP, like I mentioned, so there's going to be GDP reports this week on euro, and this is going to be on the 31st, and that will be on Tuesday. So euro, watch out for euro. It's dangerous to trade this pair at that time, especially if the market has not given you the direction. Even at that, the market maker can decide to take liquidity above and below, and that is called whipsaw up and down. So this is very, very important. Italy, that's still euro, still coming up on that same day. So I think most Mexico, I think US also. Employment, this is medium. That's not the major event. Look at this. New Zealand financial stability report. This event has a high impact. It's going to have high impact on this particular currency. So just go through economic calendar. Like I said, you can check Forex Factory. But because the Forex Factory is not available right now, that is why I'm using this particular website as an alternative source. Right. The next point that you should, consider is the RP of the currency you are interested in, or you can check multiple currencies. That is called intermarket analysis. So check what is the RP, the relative performance of the currency that you are actually trading in, and you can actually determine that also, this particular relative performance, on a different website, which is finvix.com. When you get to finvix.com, you would check the forex performance. Go to forex. Immediately you enter finvix, it will not show you forex, it will show you a lot of data on stock. Then at the top you see forex. Just click on forex. It's going to show you things about forex. Then you click on the performance, it will show you quote, something like this here. Then when you look at this, then you can now come to this particular area, performance. So this is going to give you something like this. And why do you need to check and compare the strength? The essence is actually to compare the strength and weaknesses of each currency you are trying to analyze. And then this can be done through tools like currency meter. This is the currency meter. And by assessing fundamental factors like interest rates, inflation, economic stability, like I mentioned in the first point. So when you have an understanding, which currency is stronger or which currency is weaker, it can actually help you make informed trading decision. In this page, for instance, we can see that yen, Japanese yen, is the strongest currency. I omitted this. On the performance chart, it will show you 5 minutes. So don't check 5 minutes. Check daily. The last is looking at the daily candle. You can check weekly also, for the entire week, which currency actually performed very well. If this is long term, the currency that actually performed very well, that was very strong, is Aussie, AUD, followed by Japanese yen. And if you check on daily, it's a bit congruent. It's what I mean is, it's in line. There is really no difference as such, because in the last one day, Japanese yen was the strongest, even though in the last 1 week, Aussie was the strongest. But both of them are actually in the strong zone, while the ones here are weak. So this analysis is important, for you to be able to identify the currencies that are weak and the currencies that are actually strong. I think my network is weak. I beg your pardon. Okay. All right. So if you look at yen is the strongest in the last 1 day, followed by Aussie. So what this means on the chart is that any pair that is pairing with any currency that is pairing with yen, you need to look at it here. So the worst performing currencies are franc, NZD, CAD. So if you merge USD is on the medium side. It's neither here nor there. So if you pair these two, just by looking at this data alone, I can tell where USD JPY is actually heading, because if USD JPY is paired, USD is actually not strong and it is also not weak, while yen is actually weak. So I know for sure that this pair is going to drop. It's going to drop because yen is stronger than USD JPY, USD rather. So that pair is really going to drop. So that is an information that you can get on this page using FinVix. Okay, so having done that, the next thing you need to do is to determine the global trend and the local trend. What is the global trend? The global trend is the overall trend. It's the trend in the last 2 months and the last 3 months, while the local trend is the trend in the last 1 or 2 weeks. That is the local trend. So you need to analyze the broader global trend and the local trend specific to the currency pair that you are trading. Global factors, include the geopolitical event, economic condition, and the market sentiment. While the local factors may, involve the country-specific data and policies. And this may require that you may subscribe to Bloomberg or any other news source. So when you identify the prevailing trade trends, it's going to help you to determine the market bias. Okay, so let's do an example here. The global trend on GBP USD is bearish, and then for we traders, the best area to trade, or the best factor that should prompt you to trade or enter a position, is when the global trend and the local trend are in harmony, when there is a synchronization between the global trend and the local trend. If you look at this pair carefully, it has been in a downtrend since July, August, September. This is September, and then we are currently, October is already ending. In 2 to 3 days, we are out of October. So the global trend of GBP USD is bearish. Now you need to identify the local trend, which is the weekly trend, 1-2 weeks. So if you pick, this is a week, 16th to this point is like a week. So if you look at this, the trend here is actually a consolidation, is in a range. In this case, you won't say that the local trend is bearish. It is neither here nor there. But here you see that there is a rise in the local trend. There is a rise in this local trend. If you look at this point here, from here to here, the trend is what? Local trend is bearish. So this is where you would actually maximize a lot of profit, because your local trend is in harmony with the global trend. Sometimes they are not in harmony. Like, take for instance, the global trend here is bearish while the local trend here is bullish. This type of trade, of course, for intraday traders, they will make money, while anyone who is a swing or position trader may actually lose money because this trend did not last. So you need to identify the global trend. What is the global trend, and then what is the local trend? So once that has been identified, and what are the things that actually determine the global trend? They are geopolitical factors. So you may need to understand the geopolitical factors of the currency that you are trading, and then also the economic condition. For instance, USD JPY, the Japanese yen, they maintained a particular stance. Like I told you, the Bank of Japan, has been dovish for quite some time. So having an understanding of that would help you to know that pair USD JPY will continue to appreciate in value. So you just keep buying that pair. Let's take a look at the pair. You just keep buying because of the Bank of Japan. So you may need to read about the position of the central bank of the currency that you are actually trading. So if you look at this particular pair, you see the global trend is so bullish. You can see this pair has been in a long time because of their stand. So this particular understanding will help you. What you just do is you just keep buying, keep buying, keep buying, keep buying this particular currency, because you have an understanding of the economic factor, the position of the center of the Bank of Japan. So I think that is clear. Then the next thing is to now identify key zones. To identify key zones, there are some technical analysis tools that you can use to identify your key zones, depending on the ones that you are cool with, you are okay with. There is support and resistance level. The trend line can also help you to identify key zones. Chart patterns, like for us, we use a combination of all. We use support and resistance, like you see in my chart here. We have support and resistance here. We use trend line. Like channel is a combination of two trend lines. So this is like a trend line, but it's in a channel, right? And then like in the previous analysis that we did, we talked about market geometry. This is also a part of market geometry. So, and then chart patterns. Maybe you've heard me talk about the ending diagonal, leading diagonal, triangle. These are patterns. And then the last time we did an analysis, I talked about harmonic patterns like Gartley, butterfly. I think I have one here. Let me quickly show you for those who might just be joining us for the first time. All right, if you look at this particular pair, we spotted an emerging butterfly, and that was exactly what happened on USD JPY. We said it was here, as at the time we did the analysis, we said the market has the potentiality to come up and before the drop, and that was what happened. The market left this point, came up. This is less than 50 pips, the drawdown, and then has given more than 80 pips from this is the point that we are key area. So pattern can be your key area, can be your key zone. Support and resistance can be your key zone. Trend line can be your key zone. Just try to identify which one. It may be the combination of all. It's your choice. So these zones will act as significant areas where price may actually reverse or continue to trend. In this case, these are reversal patterns. Any harmonic patterns you see are reversal patterns, like the pair is in a bullish condition, and then when we spotted this pair, it alerted us that there is a possibility of a reversal coming in, and that was what the market did. So you could have a continuation pattern. There are some patterns that when you spot them, they are actually continuation patterns, like flag patterns. They are continuation patterns. So depending on what is okay by you. So, and then for some people it could mean psychological zones. Like psychological zones are round numbers, like this is 150 is a psychological zone. 150 150.5 is a psychological zone. You can see that it actually matches with the psychological zone here. So depending on what is your preference, just for the sake of psychological zone, so you can see it's actually coincides with the psychological zone, because this is like a rejection candle, a doji, an indecision candle. It's a rejection candle, it's an indecision candle, rejecting that area. So this is a valid psychological zone, and it's also a key zone. So I believe this is also clear. Let me get back to the points. So what are the other things that you need to identify? Then you need to define your trigger. Define your trigger. Having done the first 4 items, then you need to define your trigger. You need to establish. What this means is that you need to establish a clear trading strategies. Like you need to have established that this is just forming your strategy, but this is like a routine. A routine. This is something that you do every day before you enter the market. So now your trigger is a strategy, a trade plan that tells you when to actually enter a trade, which includes divine, like this particular trigger defines your entry, it defines your exit point. How much are you going to risk? How much are you targeting? Your trigger could also be based on specific technical indicators. If you are a fan of technical indicators, there are a lot of technical indicators that could actually serve as a trigger. It could also be patterns, like I showed you the other time, how we use the harmonic pattern to identify a reversal zone. It could be a combination of both, like technical indicators and patterns and trend lines, in alignment with your analysis, depending too. And then you should also bear in mind that setting stop loss and take profit level is just good for risk management. You need that, otherwise you would not be long in the game. You need to have, an area where you want to come out of the market. You can't stay in the market indefinitely. You are not the owner of the market. You do not own the market. It's an $8 trillion market, I beg your pardon. So you can't remain there. You have to come out at some point. So, like I said, these guidelines are just to help you to be able to conduct in-depth technical analysis. This is not exhaustive. This is not all. You could add to what I have done, but I think this should help you prepare for your trading week. If you could actually check all of this before you start trading, I think it would make you better prepared psychologically. It's also going to give you a sense of diligence that you're actually doing the right thing, unlike just jumping on the chart and then drawing trend lines without knowing, the underlying drivers of the market. So you need to have an understanding of all of this before you can now position yourself properly in the market. So guys, I believe this has been helpful so far. Can we just quickly take an inventory, and then we have some analysis that we have done, and then they are mostly intraday analysis, but in a very short while, can just permit me to go over what we did last week. All right. One of it is USD which I have shown in the example. We are now doing inventory. So USD the last time we spotted, emerging butterfly, the market was here, as at the time that we submitted the analysis, it was on Sunday. So if I bold in the chart, we were here. This was Sunday. This was exactly where we were. And then I drew that the market is going to come up here before reversing. And what happened was that we waited for the market to do what it did as the market was forming. Now, this is very important. We could have pattern inside pattern. If you have studied harmonic patterns, I implore you to actually study harmonic pattern, the work of Scott. It's a very academic, work. So you need to understand that there could be patterns inside patterns, and that could be complicated at the early stage, but as time progresses you will understand and you get used to it. So on an intraday basis we also spotted another. This is what's it called, this is based on the parameters that we saw here. This is a crab. This is a crab. So when we saw this crab, we knew that the market still was going to go up, and then so we divined this was the entry point, this was the exit, and this was the target for us. We knew it was going to go up because we've seen this emerging, butterfly. One thing about the harmonic pattern is that it will not go up immediately. It may first dance around, come down before coming up. So you need to get used to this. It's not to make you sensational. You have to wait for the market to come to you. So when we spotted this, we entered here, and then we took this was on our private channel. We didn't upload it, so we got on this trade 55 while we were risking 26. So this was about 2 RR, not exactly up to, so not a bad one. And then the market came here. When the market came here, we're targeting, we're going to risk 55 pips, and then we entered here. So 55 pips was going to be around here. The market did not, this whipsaw didn't get there, and then the market is now in profit. We are now 87 pips in profit. So that is number one trade that we took, and then the analysis that we also did. Right. The second analysis is on NZD USD. We did analysis of NZD USD. Yes. Okay, so this is how it looked on the higher time frame. We were looking for emerging bath, like, okay, so, and this was, we have already marked out the area when we did the analysis, as at the time we did the analysis the market was here. So we spotted this bath or shark pattern, and we were expecting the markets to drop to this area. It is not compulsory, but what we are saying is if the market does come here, then we'll be looking for a reversal to the upside. But that does not mean that we'll short, you understand? So what we are saying is we'll wait. This is the area of trigger, like I told you in the just concluded session, that you need to identify your trigger. Our trigger is this pattern and not the assumption. The market may choose to go up and not form this pattern. So if we are taking a sell here, we would have lost. So what I'm saying is we need to wait for our pattern to be fully formed, and then that becomes our trigger. Then we'll now define our entry and exit. So we have not entered any position on this pair because our trigger is still, in the process of forming. So we'll only take the position when the market actually gets to this zone. All right. So we are still waiting. So we are sitting on our hands for this trade to fully form. All right. So the next pair that we also looked at is USD CHF. Now on USD CHF, we were here as at the time. This is a perfect example of what I just explained, that the market, the fact that we said the market was going to come here does not mean that the market will do that. The market may choose to go up before coming down. But when the market gets here to this zone, then it becomes our, key zone. And we can be looking for, entry criteria here. So but here we cannot do anything unless the market comes back here. So I believe this is clear. So the market is still unfolding. We're expecting more data to come out this week. If we have more data to confirm these buyers, then we would jump in. All right, so that is not going the way we expected it, but the market may still come there. Okay, so the next pair is USD card. USD card. So for USD card, what's happened is, as at the time the analysis was done, this Gartley pattern had been formed, and we've seen market respecting that pattern up to this point. Yes, here the market, we did the analysis at this point on Sunday. This was Friday. Then this is Sunday. So this was where we markets were when we did the analysis. So we said the market has the potentiality to come up and drop, and look at what the market did. This is our zone, right? So the market came up to this point and dropped to this level, 68 pips, before going up. Now this is critically important, having risk management and then divining your exit and entry point. It is critically important. You need to divine it. For this one, if your stop loss is 50 pips or 30 pips, you would have made a 2RR and then you would have come out of the market, because having an harmonic pattern doesn't mean that the market will actually fulfill the entire price objective, and that is why you need to manage your risk as you go along. So what happened is that the market reversed, and then it didn't get to this was the target, ultimate first target, and this is the ultimate target, but the market did not get to neither. So what happened was that the market reversed to the upside. So but are we going to say this pattern didn't work out? It did, because this was where the market pattern was formed, and then the market dropped to about 77 pips. So, and this is not a very big pattern, so it was positive. It's just that the market, so if we had entered this trade, we would have taken partials at 60 pips. We would have taken partials. So that is also one of the analysis we did last week. Then I think did we do areas? Okay, so this pattern also we identified last week. This was exactly where the market was when the market was somewhere. Okay, the market was here. Look at the market was here when we did the analysis. Sunday. This was Sunday. Yes, this was where the market were, and we said the market was going to come up here and then drop. What happened from here was that the market came here to our significant key zone, and then when it got here, let's see how many pips the market dropped by. When the market got here, we took the trade, and then it came down. It dropped right by 119 pips, 91 pips, 191 pips, and then the market reversed again and then still dropped. So anyone who had taken this trade would have also taken 191 pips, and then you would have been taking partials with 60 pips or 50 pips stop loss. If you are taking 50 pips stop loss or 60 pips, let's assume 60 pips, you wouldn't have been triggered. And then with this move to the downside, 194 pips is more than 2RR. So I encourage you to have a profit target. You can go for 1.5RR, but I think the best one it's 2RR. You can go for more, but for harmonic pattern you don't have too many RR. If you are using harmonic pattern to define your your profit targets, your risk to reward is not that crazy. You have decent risk reward. So that is one thing that you should know about harmonic patterns, because this may well be 1 2 3 4, 1 2 3 4 5, or 1 2 3 4 5. This is 3, 1 2 1 2 1 2 1 2. Then so this may well be wave 4, and then we're going for wave 5. So this is just to tell you that we are going to have a correction. So do not have to like a lofty expectation of the harmonic pattern. It's just give you decent but not a crazy RR. All right. So I think we've done for all the pairs that we did last week. Is there any other pair? All right. Then we did Amazon updates last week. We said that Amazon was going to drop in wave. So this was when we we did the analysis on Friday. This was so the market was here when we said it was going to drop. What happened was the market dropped in wave C, and then we saw a gap on Friday. I think this is in response to the US attack in Syria, hitting the two Syria military facility in Syria, and that was the reason for this jump, this gap. So economic events, can impact the markets. This is very, very true. It can impact the markets. This was what caused this jump. This was what actually caused this jump. This may be like a glimmer of hope to the American company, because when the US soldiers or the military were being attacked in Syria, I think about 20 rockets were fired, and then so the stock was dropping. But when there was a response from the US military, I think this gave a glimmer of hope. This is just what I can say. It is not a standard explanation, but this is just what I can say hypothetically, from what I can read here. So we don't know, but from Elliott wave perspective, we still should have a further drop in Amazon, stock. All right, so I think that is all from last week analysis. So overall, we had this moved in our favor. For anyone who took this trade, you have entered here, you have 88 pips, 88 pips in profits. Then you would have, maybe closed per share or something before this jump. So that is all for now. Sorry, I do not want to make this analysis long, but because of the training, I beg your pardon. Bear with me. Subsequent ones will be so short. Thank you very much for your time. I wish you a profitable week. Bye for now.